Welcome back. And with me is Eric Folkemer, the head of the Nasdaq Private Market. So welcome, Eric.
It's great to be here. Thank you.
So now I was really interested in, I've been here for a few years now, but I didn't realize how big of a business the private market was. So tell me a little bit about that. What kind of companies are you working with?
Yeah, so we focus on a variety of companies from a variety of different sectors, predominantly tech.
Okay.
Coming out of California. When we look back when we started this business in 2013, the majority of companies was coming out of California.
Yeah.
And
well, there's so much innovation going on.
There's so much. And then fast forwarding it to today where we are, there's a lot more diversity geographically, globally, and a lot bigger presence within the New York and Boston area. You kind of think about where the venture money has come from.
Yes.
And the pockets of that money. That's where we are starting to see a lot more growth across the US particularly. But when we started this business, it was actually a direct reflection and reaction to what happened in 2012 with the Jobs Act.
Okay.
I think one of the things I want to do is kind of wow the audience. And if you look at 2012, there was only about 20, maybe 24 unicorns. The idea of a unicorn didn't really exist at that point. When the Jobs Act went into effect, I don't necessarily know appreciated the results of that. And they changed the amount of record holders you could have in your company. It went from 500 to 2,000, and employees, which is a big part of our compensation, certainly culturally here in the US, no longer accounted to the records of a number of shareholders. So when you kind of fast forward today and you see these headlines with 150, 160 unicorns now in the market, I mean, that's really because there's no forcing mechanism from a regulatory perspective to bring these companies to the public markets. And so the shift has been around companies can almost choose their timetable.
It's fascinating. And the Jobs Act, you're right, is underappreciated for how much it changed the structure. I mean, crowdfunding came out of that, and Reg A+, and it just kind of all these different ways of raising money for companies and kind of democratize the process as well. So, the Nasdaq has an announcement then about the pre-IPO stage companies. So talk to me about that.
Yeah, so the answer was we had an absolute record-breaking year. The amount of activity, the amount of companies we work with, we grew about 50% year over year from last year, worked with over 71 companies last year, and helped support and deploy on the secondary side of things about 12 billion of capital from employees, early investors to the institutional side. As a business, we focus more on the institutional side, partnering with companies directly, designing market models, structures for their benefits, and how they can tap into the private sector from a liquidity perspective. The lion's share of companies have followed the common path of exercising this as more of a form of a tender, where they're going out, either partnering with Nasdaq or their banks and brokers, finding secondary capital, and making these broad offerings to their employees. So what companies are spending time on today is thinking about how can they design this into the culture of their company.
Why would I come to you? At what stage would I come to you? And what would be the benefits? And walk me through that whole process.
Where we see a lot of activity today is companies, given the awareness, given the comfort and confidence that the secondary markets are a very vibrant place to offer liquidity, they are actually planning in advance. And so the average company we work with, certainly I think you can see from the report, a lot of them are 10 years plus. We're also seeing a greater lion's share at the 6 to 7 year time period in the Series C, Series D stage, and they're thinking about it more on a repeating basis. You know, how do they kind of design it so they can offer it periodically to their employees and shareholders up into the point where they decide to go public.
So we've talked a lot about the companies that are going public and their point of view. Is there anything that investors would see or benefit from this process? An average investor who's got money in a 401k plan.
Yeah, so let's just start on the employee side. So there's a lot of benefits from the employee side of companies taking a proactive approach to offering liquidity. If you go back prior to 2012 when we started entering the market, employees, early investors were kind of left to their own devices when they needed liquidity, either because they had a lot of paper value and they wanted to monetize some of that to purchase a home or make kind of those personal decisions for themselves. It was kind of an opaque market at that point. And it was very challenging to find where would someone be on the other side of those trades. And that activity certainly grew, and it still exists today, but much more on a limited basis. So companies starting to see this activity decided, how do we proactively offer this on a more broad base? And as such, companies are able to offer it to a larger share of their employee base. And we think and are confident that this is a better market model mechanism for price and valuation. We're able to aggregate a number of employees and early investors together and line up institutional capital on the other end of that, using disclosure and information, providing it to those buyers, opposed to previous years where it was left to an employee kind of, like I said, on their own devices, trying to find someone without information, without disclosure. And so that's...
So I'm hearing transparency is a key part of
Absolutely.
this, and price discovery
Absolutely.
is a key part of this too. So thank you so much, Eric, for coming and explaining this. The whole process is fascinating.
Thank you very much. I appreciate it.
Yeah, and thank you as well. We'll be right back.